Hi guys, how are you doing? So today we will be talking about something really different and a different lens through which we can look at the market. So we would be talking about how the institutions actually act in a certain situation, how they trap you up, how they actually close your trades, and how we can think like them, how we can act like them, and how we can understand their potential. So it's something more on the side of understanding that how institutions work. So here we are looking at Q, that is Nasdaq, and we can see that how potentially this Nasdaq actually functions. So in order to understand that, we need to understand that the opening and closing of the New York Stock Exchange, that is based on the Eastern Standard Time. So the market rings the bell on 9 at 9:30 a.m. and ends at 4 p.m. Or so this is a fixed timing. The each blocks which you are looking at is basically a New York session which we are looking at and which we can discuss. So I'm basically starting from Monday. So here we can see that as the 9:30 happened, the prices uh, tanked down really fast, showing that the sellers exist around this point. Then we can see that this is a 15 minutes bar, and each 15-minute bar has three 5 minutes candles. So each 5 minute candle can move a lot and can make your PNL move really fast on each side. So you have to be like super prepared for the risk because it's really intense when you are a beginner. So we can see that the prices went open around here and closed around there. Then we can see that there is a there is a buying strength, a little bit of buying that started coming in here, and we can see that it also like really coincides with like the previous pre-market session right here. And most of the retailers might be perceiving that it can go up here directly like that, but this is where the institutions actually play their role, and they kind of like trap you in these kind of scenarios that you just start thinking that now the buying has started, because you can see that right here 115 minutes bar has developed bullish, and it is not as prominent and as great like where we can just say that the price is going to be pushed on the upper side. But as we can see that as the prices went up, there's a little bit of a pullback, a retest that happened with this bullish hammer right here that actually can show us that the prices might be pushing on the upper side. But we can see that this was a trap. Most people who have bought right in here at this point uh, might have like hit their stop loss around there, around the bottom of here. They might be getting stopped out, or if they are not, so you can see that the people who were buying here, later on the prices went down there and start went up till here, right here. And even like after in the next pre-market session, the price is pushed on the upper side. So people who just actually bought here or might have closed earlier, they would be saying that why they have done that, because they might be saying that they are right, or most people would be uh, getting mad at themselves in this case. So this is this is really important that you should place the stop and get out, because uh, you don't understand like where the price can actually move. But in this case we can see that the the, the market actually made the people, or made the retailers to specifically go on a sell side, because here you can see that after that the price break down really quickly, pushing the prices on the downside. And then right here the price is like making a channel right here, showing and indicating that the prices might go on further on the downside. And we're here we can see that there would be like there are many cases like people would be like selling around here, like around here they might be placing the sells here, and then again the prices went up and went down, and they might be selling around here as well, expecting that the price to go down. So the thing is that how the institutions created the mindset that of the retailers, that they they would be pushing the prices on the downside. So more the sellers, more buying capacity they had. So because institutions, when they place a trade, or big hedge funds or proprietary groups, trading groups, whenever they need to place the orders, they need to generate the liquidity in the market. They need to bring the people in here, because if there would be if there wouldn't be any sellers in here, there wouldn't be buying that is happening. So in that case, we can see right here that each time after these specifically these panic selling around here, or the momentum of the selling momentum which actually came in here after the breakdown of this point, we can see that each time everybody would be trying to sell around here, around there, and after many people would be executing sells in a hope of the prices to actually go on the downside like that. We expected, we suddenly got a sudden push on the buying, and we can see that how fast this buying actually went. So, and how parabolic it is, like it went really on the straight line without any sort of like proper pullback, like price didn't even take any sort of rest around here. So in that case, you need to understand that how institutions specifically generated this liquidity on the sell side, and after that they actually use that liquidity to buy more on the upper side, even stopping these people out and squeezing these people out. And on the other hand, let's move forward, and we can see that now a new day begin from here, and we can see that how the prices opened around here. We can see that prices actually went on the upper side. Then again, see how this is the liquidity generation is occurring right in here, and we can see that each time the price is pushing on the upper side, we see this 15 minutes red candle around here. So this shows that our sellers were induced in here, and it's a big move that actually happened. Like you can see that this buy happened, and similarly this sell side candle developed, which is equivalent to the body of the previous candle that was the buy. And then again, price pushed on the upper side, again price pushed back on the downside, like showing that the price would be going on the sell side. And this engulfing right here, you can see that how this engulfing is looking, like it is looking super prominent, that price might like break down and come back down there, and we might expect the price to go on the downside. So as they have generated the selling momentum in here, showing that there is a good selling momentum in here. But if you see and count the bars, you can see that each time the red bars, which shows the selling liquidity, which shows the selling strength, which shows the selling momentum, you would see that they are much bigger. You can see that the candles are much bigger. They are like 15 minutes bar of the sell side bar is more bigger. This is more bigger bar than this previous one. And similarly, like see the rejection that is happening, and you see the buying bar, they are like really small. So this shows that how they actually trap the people on the sell side, and after generating this selling liquidity, they actually push the prices on the upper side further. So this is what we should be aware about, that how institutions actually specifically react in order to generate the liquidity from the retailers. And after that, they have pushed the prices again. The market actually closed around here in the pre-market, and after that even the price went on the downside. So people who were selling around here, and they might be getting stopped around up here or maybe up here, or they couldn't even hold that for that long, because in futures we do have a problem with that. At a specific time from 5 to 6 p.m, we do have a margin that is applied, that is really a lot of money to hold the trade in the futures market. So most of the people might have like closed down the trade, and later on they could have like seen at the late night that how the price is dumped on the downside, and they might be like, we have missed the chance. So these are the certain kind of emotions that sometimes like traders face. So let's see how the liquidity was generated in here. We can see that on at 9:30 we do had a like a selling candle, and then again a selling bar around here, that it that shows that the price can even further push on the downside. So most of the people would be looking around here, looking for a pullback and continuation of the prices pushing on the downside. So there would be a lot of orders that must be getting placed, because in futures usually like there's a general concept of day trading that you use 5 minutes time frame, 3 minutes time frame, or 1 minute time frame in this case. So we can see that most people would have been looking around here hoping that they would get a rejection around here and prices start going on the downside. And here we can see that the prices actually broke out and generated much of a liquidity around here on the sell side even. And more the sellers, more the buying capacity they have. So prices pushed on the upper side, pulled back, continued, and again right in here we can see that uh, there is a double top that formed around here, pushing the prices on the downside. And most people would have been expecting the prices to even go on the downside further in the continuation of this past sell side move that happened with the momentum. But we can see that again there was a breakout that happened, and similarly in this case, trapping people. We can see this rejection around here that is like a swing failure, or we can see that some people might be thinking that this is an order block right here, and prices touched there and showed the momentum on the downside, and they must have taken the sell position around here. And later on, like, the prices further broke on the upper side. So see how the institutions actually react by imposing or inducing the fake sell side moves and pushing the prices on the upper side further. I do understand that a lot of fundamentals are behind this move, and a lot of fundamentals are acting behind it, but we need to understand that how the market structure is being formed right in here. So in that case, the reason for telling you guys is that the market structure is also important. Along with that, the fundamentals are also important, so we need to align both technical and fundamental sides of the trading. So this is how they actually push on the upper side. And let's see how the liquidity was actually generated around here. We can see right in here that the price opened in 9:30, price formed this big wick around here, and after that the price came back down there. So it's like a long range that actually developed in the pre-market, and wrong and then after that we can see that after inducing like on the selling side, bringing like hopes, bringing emotions, bringing perceptions on the sell side. And most people might have executed the sells around here expecting the price to at least come around this point or come around these levels around here. So they push the prices on the upper side. So people who had taken the sells around here, they got trapped, prices went up, they locked in the profit up here, prices came back down there, and again these range, structural range, has started developing around here. Most of the people would be selling around here. Even I could be the victim around here, that I would be selling around here. After looking at this rejection, price came back down there, again price went up, came back down there, again an engulfing developed on the upper side, stopping everybody out there. Again, you can see this is a good evening star right here, which we read in the technical books. And then again the selling candle developed here, but prices were unable to break on the downside. And after that, what we are looking at, that prices again went up there, again rejection. It's a really big move, guys. Like, if you see that, it's not easy, it's really difficult to specifically like trade in this kind of environment. And after that there's a small selling part that actually develops, and again like a price pullback. Most people might have taken the buys around there. So uh, after that, squeezing the people on the buying side, and you see really important stuff similarly to the previous side. I was telling that how big are the buying bars. You see right here that big buying bar is really big. It's an engulfing, literally an engulfing this. And we can see right here that the selling bars are quite small, but buying bars are looking really big, that might be also trapping the people up. And then there was a breakout. So after the breakout, the price pulled back and continued on the downside, and then the market closed. So what I actually mean by that, the people who were buyers around here looking at this structure thinking that the prices could be going on the upper side, they must be trying around here. Like, see, this is a pin bar right here, and this is an engulfing. So in a hope that prices pull back and continue on the upper side like that, they must be like taking the trades in that case. And later on, more the buyers equal the sellers, and they took the market on the downside in that case by inducing these buyers around here. So I understand this is all is happening on the historical data right now, but there is but it is like a fact. Historical data is also a fact, is a factual data that actually what really happened. So let's say a new day that the price opened around here. This is an engulf that happened, and around like um, around like 10 o'clock, and after that you see like how these rejections started occurring here, right? People would be like getting induced for the selling side, and even I am like victim to this sometimes. So it's not nothing about a shame, but it's really important to understand the direction of the market. If you get stopped out, use that stop loss for judging the direction of the market rather than like thinking that you have lost something, because when you get a right direction you can actually compound your entry and like get really big and push more on push more gas on the pedal, so that you can actually make more money that you've lost. So in that case, more people might be like trapped around here, like these range. It is like each this range has like these are the 15-minute bars, and each 15-minute bars has like 3 5-minute bars in there. So there is a big it's a big time, it's a huge time. So um, we can see right here that there was a breakout that happened after like inducing selling momentum in there, and then prices pushed on the upper side. So the big players or institutions, what they did is they generated the sellers in there, and after generation of the sellers and making people think that the prices are going on the downside from here, they actually push the prices on the upper side. And later on, we can see right here that the same thing is happening, that you see prices pushed on the upper side, came back down, pushed further on the upper side, looking that giving the indication that they're going to break out further on the upper side like that. But what ended up happening, that prices came back down there. So people who took buys around here got stopped out, and after that the price came back here again, pushed on the upper side. And after that, they actually, people just thought that prices might be like pushing further on the upper side, and you see like without any warning there is a big sell bar that developed, and then again the the day closed. So this is what I'm just trying to explain you guys right in here. So similarly, right in here we can see that these are the long wicks that the prices actually opened around here, came back down there, again went up, and went on the upper side like that, and further on the upper side like that. Again, these big wicks around here, they are like kind of like traps. So they might like squeeze your hand a lot. And then people might be thinking like through a textbook pattern, as you might like not the beginner traders, but like people who are trading for quite a long, they consider these kind of long wicks as the swing failures, or like the prices might be going on the downside because the buying momentum doesn't exist in this scenario. And what ended up happening, that prices came back down there, but all of a sudden these buying momentum again came back and again started pushing the prices on the upper side. This is a really good pattern. This specifically, like these four candles are really good pattern for indication of that the prices would be going on the downside. Most of the people would have been trapped around here, and then prices went up. They might have like closed around here, the stop loss might have hit around here, and you see right here again the price pushed on the upper side with this engulfing, and then a selling momentum actually begins. So everybody who was trapped here on the sell side, the prices actually went on the upper side. But when the real selling came, it came really fast, and people might have misjudged it, and they might have like exhausted their mental capital. So it's really important that we actually I would tell you the technique later on, that how we can actually save ourselves from this. So it's the similar case right in here that I would be going through really quick. That prices opened around here, gave us the selling momentum, and you see like from the previous side there was a lot of selling momentum too in the pre-market, and even in the New York session of the previous day we had the selling momentum. And uh, as this selling momentum was happening, you see how the buying started all of the sudden. So people got trapped into the selling momentum, and then the, the price pushing on the started pushing on the upper side. So this is a trap again. We can see right here that everybody would have been like selling around here. Even I am the victim many times of this thing, but I do understand that when my time comes, so I just push hard on the orders, on the trades which I take. So then again, like these people got stopped out with this big wick. And how important is the stop loss? And then again the prices came back down there, came back down, pushed on the upper side and came back down. So this is what the institutional uh, the idea behind this institutional concept is that people do get, basically the retail traders do get trapped into the market, thinking that it would be going on one side. But and market also induces or portrays in a certain form that it would be pushing in that direction, but later on we can see that the market push on the other side. So you can see here that again the selling momentum came, there's a break of structure that happened, price went up, got rejected, pushed on the downside, thinking that prices. Then here on this week we can see that price opened around here, came back down, came up there and came back down there. People who are looking on the lower time frame at like 10 minutes or 5 minutes, they might be thinking that prices like would be continuing on the downside, pushing towards this level, and then again the prices went up and they got trapped, they got squeezed for quite a long time, and again the prices came back down there, and then a big pump on the upper side as the price reopened at 6 o'clock. So now the idea is that it's a similar case that is happening every time. We can discuss any of this thing. Like this is a good idea. That so today, what really happened, that the prices opened around here. We can see that prices were in a selling momentum. There was news that was also showing that the prices would be prices can get weak on the fundamental side as well. So all of the sudden there was like a Trump's speech that actually pushed the prices on the upper side. But on the technical side, we can see that prices came back down there, pushed back again, came back down. This ABC pattern showing that prices can actually lead on the lower side like that. But what ended up happening, that prices went up. So many people would be trapped around here on the sell side. Even I was trapped on the sell side. But as I saw that the momentum actually increased on the upper side, like here the body was covered by this wick, the prices went up, so I was able to execute my position around here and closed around this high. And later on the price went on the sideways, and after that price went on the sideways like this. So prices went up, came back down there, closed below this point, most probably like showing that there could be a selling momentum in here. But now where should be the execution? The idea was that this type of like move doesn't like work most probably. Like what we should be looking at is that if the prices go up, and you need to understand the reversal pattern, prices come back down, wait for these highs to be taken out. That is like people who have taken short position around here, because the idea of the market structure and how the price movement happens is like they wouldn't let you sit, that's for sure. You can't sit in the market. Any point where you have placed a trade, it would be getting retested for sure, for sure. Not maybe on a certain time, but like maybe after like 10-15 minutes the prices would be back retesting that level. If you can hold that, or if you can if you have a better idea about that, that you can actually hold that, you can sit in the market. But if you get scared, or if you become fearful at that point, you would be, of course you would be closing out. So more buyers coming in here. See, the prices came back down there. So there was a big buy. Again, the prices came back down there. Most probably, like, people would be thinking with this week that prices would be pushing on the side, on the upper side. They have induced the buyers here. Again, prices came back down there. Again, a buying candle here that buyers have induced here. So most people who are buying, so retailers on the buyer side, so who would be like, buyers would be selling. So of course the institutions came and pushed the prices on the downside because they have generated the liquidity around here. So if more buyers are on this on a certain side, then institution can actually execute the selling orders on the other side by squeezing them and stopping them out. So the idea here was that prices went up, came back down there. I was waiting for a certainly like a swing failure pattern or something like that, that all these people who have taken a short here would be like closed out in order for the price to move on the downside. So what ended up happening, the price went up, came back down there again, price pushed on the upper side. If I would have been uh, certainly a beginner, I might have like taken this trade. And no doubt, like, if you are even an expert in this work, you would still have taken this trade. So this is how, like, certainly, like, they formulated, they kind of like move the candles in a certain direction, in a certain way, that it just shows you with the confirmation that there would be an execution on the buyer side, or there are executions on the, or volume is coming on the buyer side. But what ended up happening, that prices actually came back down there with high momentum. And as the prices came on the high momentum, I was able to, like, as the prices reached this point, I was able to execute the position and got out around here. So this is like a certain thing. So how overall, like, maybe like the concept might not be as clear to you, but later on um, with more practice and more understanding and more experience in the market, you might be able to like understand that. But what I really want to say, that how you can actually save yourself from it. And there is only way one way that I have actually found that, and it is through your own trade plan. If you have planned a trade, you need to actually execute and trust in the process. So if you wouldn't trust in the process, like, for example, if you have like placed a stop loss right up here, right, and you have executed a sell position around here, and price went down, you are supposed to actually exit around here. If you wouldn't exit, this would be a biggest problem. Exit yourself, use a hard stop loss in that place, and you would get stopped out. It is much better, because you can't understand or find a specific direction of a market, that how things are happening. You have to let the stop loss hit. But on the other hand, if you see that now the prices has been showing us the momentum on the upper side, and you have like, you got stopped out, and you know that after that price pulled back a little bit, you see price went up, came back down here. If you see this structure right in 5 minute time frame, let me show you. Even on 1 minute, it must be more clear. So you know that the prices has went up. So as the prices went up, pull back, and you can see the momentum that actually exists. You can actually take a buy, then a buy position on the upper side, and capitalize on that. But only way to get yourself saved from this thing is only through, just give me a sec, to save yourself from this thing is only through your own hard stop. Because if you get stopped out, or if you think that you can actually hold this trade and like this would come back, you are never sure about that. Because as a day trader, you need to get stopped out here, because if you have taken a sell around here and you're hoping that prices would be going on the downside, even like leading and reaching around here, but it didn't happen that way, just stop yourself out. It's fine. And then later on, when you understand that where the big players are pushing the prices, or if the prices are being acting based on the fundamentals, in that case you would understand that prices are going in the direction, so you can just take a trade on later on the upper side and catch the momentum. There is nothing to worry about. Similarly here, you can see that uh, people must be like thinking that prices are pushing on the upper side, and of course like there is a good momentum on the upper side. We can see that there is a price movement that is happening on the upper side, and here we can see this parabolic move on the upper side that shows a lot of strength. And right here we I do expect that prices can move further on the upper side. It's a equal possibility. But when you're day trading and you are dealing with some lower time frames, you are not trading on like 4 hours or like 1 day time frame or something like that, so there is an equal chance that there would be a noise in there. So in order to eliminate the noise, what you need to do is certainly execute your trade plan. That's it. If you wouldn't be executing your trade plan and you would be like looking around that I should like change the position, I should like uh, hold this trade and like let the prices would be coming back, I can't take this loss, it's a huge loss. This is the biggest and stupidest mistake a person can do. So only way to get yourself saved from it is just let your stop loss get hit, and you would it would give you the better direction of the market, and then you can actually execute the trade. So similarly right in here, if you have taken a selling position around here, you would be you would for surely be like stopped around this point. As you get stopped out, prices went up, of course you would be waiting. Then there is a positioning on the sell side, prices came back down there, and again the prices went down there. So in that case you could have like taken a sell around here and got out around this point, or even you could have like waited for it a little while and then again the prices came back down there, or you could have like taken a buy around here. That could give you a safe exit around there. So what I actually mean is that only through your trade plan, by sticking to your trade plan, that is executing your stop loss, is the only way to re-enter again on the better side in order to understand, because you need to take some test trades in order to understand the market direction at the certain position. So I hope this makes sense. It's like a really difficult topic, even really hard for me to explain you guys, but I've tried my best to explain that. And if you want, I can further explain in more visualized way. So anyway guys, take care.